purposes of this video is to provide you with an overview of how bond chargeable event gains can impact on the personal allowance. The personal allowance is reduced by £1 for every £2 where an individual's adjusted net income is in excess of £100,000. Therefore, someone with income of £110,000 would lose £5,000 of their personal allowance. So in the current tax year, where the personal allowance is set at £12,570, the individual would therefore only be able to benefit from a personal allowance of £7,570 after taking account of the £5,000 reduction. This means that for the current tax year, individuals who have income that exceeds £125,140, they lose entitlement to their full personal allowance. So where do bond chargeable event gains fit in? Well, basically, for these purposes, the whole of the chargeable event gain has to be added to an individual's income to determine the position. So let's have a look at an example. We've got Connor and he's got income of £15,000. He's recently surrendered an onshore investment bond, which he has held for 13 years. It's generated a chargeable event gain of £130,000. The chargeable event gain then, when added to his other income, will mean that his income is £145,000, and therefore he would lose full entitlement to his personal allowance. However, in this example, given that Connor's income is only £15,000 and he's made a gain of £130,000, he will of course be able to benefit from top slicing relief. The top slice gain is £10,000, and that's calculated by dividing the full chargeable event gain of 130 by 13 years. When carrying out the full calculation in line with HMRC's guidance as covered in the Insurance Policyholder Tax Manual, and the reference for that is IPTM 3840, for the purposes of top slicing relief, Connor could of course benefit from his personal allowance. And actually, in this example, he would have no further liability to income tax on the chargeable event gain made on the onshore bond. Even though he's got no further liability on the bond, however, as a result of losing his personal allowance, he would be subject to income tax on all of his other income of £15,000 at 20%, so he would have a liability of £3,000. Note, from a planning perspective, and given that bonds are segmented policies, in practice, it would of course be possible to surrender a number of segments over time in order to ensure that clients benefit from their personal allowance by keeping their adjusted net income below the £100,000 figure. And also remember, there are other planning opportunities available to individuals to reduce their adjusted net income, for example, by making pension contributions or gifting to charity. Well, I hope you found that useful, and remember, we do have numerous bulletins on Techlink which explore all of these options in more detail. Thank you for listening.